Hey, welcome in everyone. This is Dan French. This is Wealthytainment. We have a great show for you today. We're going to talk about a topic that's been talked about by a lot of big social media influencers out there, and it's a big topic in the economic space right now. A couple of influencers has talked about this is Patrick Bet-David from Valuetainment, also Graham Stephan, and a couple others that's talked about what's the concept of what's a reverse market crash. Now, everybody's out there is like, what is that? Well, a reverse market crash is simply put as a sudden rise in assets. And these prices leads to these rich getting richer, the wealthy getting wealthier, and the poor and middle class becoming worse off. And so rising interest rates negatively impact the valuations of real estate, stocks, also private companies as higher rates slow growth and increase borrower costs. You get that part? Increase borrower costs. That's a direct impact on anybody that needs a loan, or also inflation and economic daily costs, it's going to impact you as well. So, Patrick Bet-David came out and stated that, this reverse market crash, we're heading in that direction. This is not good for America. It's not good for Americans, and how this could directly impact you as a middle class to maybe even a poor family classification. You want to stay tuned to this video because this could directly impact you, and you want to know what to do in that situation. So let's go over and see what he has to say about this.
Ron, we're not vendors. Are you out of your mind? That'll never happen to us in the U.S. Okay, let me show you a couple things here. Take a look. Maybe you're right. Maybe I'm wrong. Who knows? But if you look at our inflation rate from 2000 till today, notice what happened in 2021, 22, skyrockets, right? Look at the rates on the next page. Our real interest rates, if you look at that, we went into negative slightly. Okay, now 2020 goes into negative. 2013, we flirt with negative. And if you look at our effective rate, at this other chart, you'll also notice where we went there. We were also flirting with 0, 0, 0 for God knows how long. And take a look at S&P 500. Look at this here, SPX. What do you notice? And roughly in 2009, SPX was at 700. Where's it at now? Roughly 4,300. It's 6x. That quickly? You mean to tell me that can go 6x like this? That's what the chart is telling me. In America, for it to happen, what are the criteria? What do we notice here? Number one, in every one of these countries, we have quantitative easing, which is what? Printing money. We did a lot of that in the U.S. Number two is when the government chooses to get involved with free market and they want to kind of create regulation and all these rules. We got a little bit of that going on. What's number three? Price controls. You got to put the price of oil at these. Some people want to flirt with it. Newsom wanted to flirt with it. Biden wanted to flirt with it. Those are the areas when you hear languages like that, we have problems coming up here. Now, why will it not happen in the States? That's a fair question. So again, the three is what? Quantitative easing, which is printing. You got getting involved in free market and price controls. But outside of that, who's typically screwing this thing? Like, who's going to ruin this great idea called America? Politicians. By what? More welfare spending, more money printing. Couple things that may come up is if this idea of reparations becomes something that they want to do, and then you and I got to pay for it, and we've never been a part of it. I'm from Iran. My family to be involved with this, but we got to pay for it because this is what America wants to do, or UBI. There's just a lot of things going on. And by the way, the other threat is the following. U.S. dollar, we know it's strong. We already talked about the 80% and the 60% currency worldwide using, but what if all of a sudden these guys that are having these meetings, right? The World Economic Forum, or all these other meetings that we're having, these summits that they're getting together. Let's create a CBDC that the whole world uses. Everybody around the world uses the same exact, central bank digital currency that we use, no longer the U.S. dollar.
So you can see what he's saying. He's pretty much saying what a lot of, it's no secret. This news has been out for a while about having the world is going towards a centralized currency. The monetary policy, which is the Fed going out and saying, are doing monetary policy by doing quantitative easing, which is really either buying into bonds or raising the Fed's fund rate to slow the economy down. So playing that balancing act that they do. So these things all impact your family because whatever position that this goes right now, if it does go to a reverse market crash, this is going to negatively impact middle class and poor families. And this is going to be on a grand scale. Rents will potentially go up. You'll start to see the consumer goods keep going up as far as inflation goes. Now, again, all of these things are concepts that have been put out there, but now it's starting to see more signs of it. There's been a bigger separation of wealth that we've seen with amongst American families. And I want to show you this chart really quick. When you look at this, the gaps in wealth between upper middle class and middle and lower income families has been rising. 1983, 102,000 for middle class, right? All the way up to 344, 100 for the wealthy. And if you look all the way and you can see, fast forward to 2001, you can see that 144,600 for the middle class, 636,000 for wealthy, and you can see that it actually declined in 2016. You look at 60% all the way up to 79% right there for the upper middle class. So you can see that separation has happened. We can also see that for the middle class, right? You can see that 32 down to 17%. And so the lower income, 7% down to 4%. And so when you look at this, 89% of all U.S. stocks owned by the wealthiest 10% of American households. That's a astonishing, really statistic that I've seen. And also, you look at BlackRock. BlackRock owns 65% of the S&P top 500 companies. That's a monopoly, right? And one of the things that you have to see is, when you look at presidents, I don't think any president, it doesn't matter what you think or believe, these families and these conglomerates that have the money, these corporations are really the ones pulling the strings of what the economy is really doing and not doing. And so when you talk about quantitative easing, why is that even in place, right? Well, quantitative easing is really a domestic money supply to stimulate the economy. So what Patrick Bet-David didn't talk about is that if the Fed takes the Fed's fund rate and cuts it by half, that's really going to impact, and this might be headed in that direction, because if the economy starts to slow down, they have to do something, right? That's the balancing act we talk about. The transfer of wealth happens at different stages, right? These stages, let's look at them, because these stages, you can see stage one is, accumulation. Best time to buy is on the way up. This is what a lot of these investors are doing. Stage three, right? It kind of levels out. And where we're at right now is the best time to sell is stage four. We're heading down to stage five. That's that cycle. So we're heading back to a point where if the Fed does lower or cut the Fed's fund rate, then potentially you're going to see a transfer of wealth even happen bigger. I want to bring up one of this here.
The group considered low income, its size has also been increasing, albeit a lower rate than the high income class. As a result, the middle class is being squeezed from both sides, most recently only making up 50% of Americans. One especially alarming trend only about the low income class is that while it has been increasing in size, it has been decreasing in its share of aggregated income. Between 1970 and 2021, earnings of the low income class decreased from an already meager 10% to just 8%.
So you can see there's already separation happening there. And, when you talk about the middle class and how this could negatively impact the middle class that's out there, I mean, you got to think that the wealthy are going to benefit from that. And if you don't own a house today, or you don't have assets, or you don't have any portfolio or any investments in place, you're going to continue to be left behind even further, right? And so I think there's no other time than today that you have to really think about putting yourself or getting a portfolio or talking to a financial advisor, somebody that's going to put you in a position to have sustained wealth, because all that's happening is the wealthy are going to continue to be able to, weather the storm, even though if you have rates come down, which obviously those are short-term bonds, those rates are rates that would potentially help the average American, middle class to lower middle class, either buying a car or student loans or credit cards, because those short-term bonds are actually an impact on what your payment would be. So that would be in the short term, it would help you. But to gain or sustain wealth, the wealthy are buying additional assets because they have the assets and the liquidity to do that. And that's the cycle you see. The cycle is exactly what we showed. There's a good time to buy. We go up, they sell, right? The Fed does their balancing act, does quantitative easing. The US dollar right now is still strong, like Patrick Bet-David said. And so there's a cycle here. And if this continues to happen, you're going to see that separation of wealth. It's obviously big now. It's gotten bigger in 2016. It's going to be alarming to see what happens by, say, 2025, right? I want to show you something here where inflation's at. So if we look at the inflation numbers here in the US, you can see that they've gone up quite a bit since COVID. Quantitative easing has gone up since COVID. We're $33 trillion in debt. We talked about quantitative easing. How much did they really contribute to that? About $7 trillion in quantitative easing from the government or the Fed purchasing these bonds, right? Also, I want to talk about if you look at where the real interest rates are at. You can see that our rates are right around where you see quantitative easing right here from 2008 all the way down to say 2022, maybe 2021. Quantitative easing, the Fed was really manipulating the economy, and now we're starting to see rates go back up again. Part of that is because they want to, the Fed's fund rate, they've raised it, and so they want to obviously, suppress and hold the economy down a bit to bring down inflation. Now, before we get into this last part, I want to talk a little bit about what a market crash would be and what would contribute to a recession, right? Or a potential market crash. Now, I don't have a crystal ball, but Deutsche Bank came out and stated 4 things to look for if a market heads for a crash or a recession. And we're seeing those 4 red flags now. One of them is that the Fed's fund rate is raised up rapidly by the Federal Reserve, right? 5.2% over the last 20 months. Also, we have what's called an inflation spike. We've seen that since June of 2022. We're at a 4-decade high of 9%. We also seen an inverted yield curve, which is U.S. Treasuries have are stuck in an inversion pace. Really what it comes down to is the long-term rate is lower than the short-term rate. We've seen that. Also, oil prices 33% higher than what they have been since June, right? And it's $95 per barrel. Those are the 4 things that we're starting to see inside of a recession, and we're starting to see that happening now. That could potentially happen here very soon if we're not already in one. Now, what's the bottom line? All right, well, the bottom line to me is this, is that if you're looking at making if you're trying to say, well, what do you want to do in this market crash if it does happen? What do you do on a reverse mortgage if it happens? Basically, it's the financial landscape requires you as an American out there to have careful investigation and carving your way into finding the right path to seek professional advice. Also consider the steps to safeguard your financial future, because I think right now you're continuously seeing a separation in the wealthy out there. Wealthy are using and reutilizing their wealth, their assets to reposition themselves, pivot, holding when the time is right to make and pounce on when they can make, either buying into assets, stocks, bonds, more of stocks, I would say, and more of housing, investments. And so you really need to have, if you don't understand how to invest your money or hold or save your money or put your money in a place for it to work for you, you better find and seek financial support or help. Because I think at this point, if you don't do something, the statistics and data is there that you're going to be left out in the cold. And unfortunately, there's not going to be a middle class anymore. We're probably going to just have poor and rich very soon if the things keep going the way that they're going. If you guys have any questions, please let me know. I'm Dan French. Please leave any comments in the comment section. I'll see you guys at the next one. I'm out of here.